Hello dear friends, in the present module 2.8 we are dealing with clearing and settlement of securities. This module would like to address clearing and settlement of securities, entities connected with the dealing of securities, clearing and settlement process, settlement cycle, then risk management, then margin requirements. Then we can see the trades done at stock exchange are settled by the clearing house or clearing corporation of a stock exchange through their clearing members, brokers and custodians. The clearing process involves determination of what counterparties owe and which counterparties are due to receive on the settlement date. Thereafter, the obligations are discharged by settlement. The clearing and settlement process comprises of the three main activities: clearing, settlement and risk management. Several entities like the clearing corporation, clearing members, custodians, clearing banks, depositories are involved in the process of clearing. The role of each these entities are explained below. The first, the clearing corporation. The clearing corporation is responsible for the post-traded activities such as risk management and clearing and settlement of trades executed on a stock exchange. The first clearing corporation to be established in the country and also first clearing corporation in the country to introduce settlement guarantee is the National Securities Clearing Corporation Limited, NSCCL, a wholly owned subsidiary of NSE. NSCCL was incorporated in August 1995. It was set up with the objectives of bringing and sustaining confidence in clearing and settlement of securities and promoting and maintaining short and consistent settlement cycles, providing counterparty risk guarantee and operating at a tight risk containment system. Now we can see the clearing member. Clearing members are responsible for settling their obligations as determined by the clearing corporation. They do so by making available funds and or securities in the designated accounts with the clearing bank or depositories on the date of settlement. Custodians. Custodians are clearing members but not trading members. They settle trades on behalf of trading members. When a particular trade is assigned to them for settlement, the custodian is required to confirm whether he is going to settle that trade or not. If he confirms to settle that trade, then clearing corporation assigns that particular obligation to him. As on date, there are 13 custodians empaneled with the NSCCL. They are Rashid Bank, HDFC Bank Limited, Hong Kong Shanghai Banking Corporation Limited, Infrastructure Leasing and Financial Service Limited, ICICI Bank Limited, Standard Chartered Bank Limited, Stock Holding Corporation of India Limited, Axis Bank Limited, DBS Bank Limited, JP Morgan Chase Bank, Kotak Mahindra Bank Limited and State Bank of India and Citibank and Orbis Financial Corporation Limited. Now we can see the clearing banks. Clearing banks are key link between the clearing members and clearing corporation to effect the settlement of funds. Every clearing member is required to open a dedicated clearing account with one of the designated clearing banks. Based on the clearing member's obligation as determined through clearing, the clearing member makes funds available in the clearing account for the pay-in and receives funds in case of a payout. There are 13 clearing banks of NSE: Axis Bank, Bank of India Limited, Canara Bank, Citibank, HSBC Limited, HDFC Bank Limited, ICICI Bank, IDBI Bank, IndusInd Bank, Kotak Mahindra Bank, Standard Chartered Bank, State Bank of India and Union Bank of India. Now we can see the depositories. A depository holds securities in dematerialized form for the investors in their beneficiary accounts. Each clearing member is required to maintain a clearing pool account with the depositories. He is required to make available the required securities in the designated account. On settlement day, the depository runs an electronic file to transfer the securities from accounts of the custodians or clearing member to that of NSCCL and vice versa. The clearing and settlement process for transaction in securities on NSE is presented as: the first step is trade details from the exchange to NSCCL, that is real time and end of the day trade file. Then second is NSCCL notifies the consummated trade details to clearing members or custodians who affirm back. Based on the affirmation, NSCCL applies multilateral netting and determines obligations. Then third step is download of obligations and pay-in advice of funds or securities. Then fourth is instructions to clearing banks to make funds available by pay-in time. Then fifth is instructions to depositories to make securities available by pay-in time. Then sixth is pay in securities, that is NSCL advised depository to debit pool account of custodians, CMs, and credit is its account and depository does it. Then seventh is paying of funds. NSCL advised clearing banks to debit account of custodians, CMs, and credit its account and clearing bank does it. Then payout of securities. NSCL advises depository to credit pool account of custodians, CMs, and debit its account and depository does it. Payout of funds. The next ninth one is payout of funds. NSCL advises clearing banks to credit account of custodians, CMs, and debit its account and clearing bank does it. Then depository informs custodians or CMs through DPs. Then clearing banks inform custodians or CMs. Now we can see the another area, that is the core process involved in the clearing and settlement. The first and foremost area is trade recording. The key details about the trades are recorded to provide basis for settlement. These details are automatically recorded in the electronic trading system of the exchanges. Then trade confirmation. The parties to a trade agree upon the terms of trade like security, quantity, price and settlement date, but not the counterparty, which is the NSCL. The electronic system automatically generates confirmation by direct participants. Then third is the determination of the obligation. The next step is determination of what counterparties owe and what counterparties are due to receive on the settlement date. The NSCL interposes itself as a central counterparty between the counterparties to trades and nets the position so that a member has security-wise net obligation to receive or deliver a security and has to either pay or receive funds. The settlement process begins as soon as members' obligations are determined through the clearing process. The settlement process is carried out by the clearing corporation with the help of clearing banks and depositories. The clearing corporation provides a major link between the clearing banks and the depositories. This link ensures actual movement of funds as well as securities on the prescribed pay-in and payout day. Then pay-in of funds and securities. This requires members to bring in their funds or securities to the clearing corporation. Then the CMs makes the securities available in the designated accounts with the two depositories, CM pool account in the case of NSDL and designated settlement accounts in the case of CDSL. The depositories move the securities available in the pool accounts to the pool account of the clearing corporation. Likewise, CMs with the fund obligations make funds available in the designated accounts with the clearing banks. The clearing corporation sends electronic instructions to the clearing banks to debit designated CMs accounts to the extent of payment obligations. The bank processes these instructions, debit accounts of CMs and credit accounts of the clearing corporation. This constitutes paying of funds and of securities. Then payout of funds and securities. After processing for shortage of funds, securities and arranging for movement of funds from surplus banks to deficit banks through RBI clearing. The clearing corporation sends electronic instructions to the depositories or clearing banks to release payout of securities or funds. The depositories and clearing banks debit accounts of the clearing corporation and credit accounts of the CMs. This constitutes payout of funds and securities. Settlement is deemed to be complete upon declaration and release of payout of funds and securities. Then we can see the settlement cycle. NSCL clears and settles trade as per the well-defined settlement cycle. All securities are being traded and settled under T+2 rolling settlement. The NSCL notifies the relevant trade details to clearing members or custodians on the trade day, which are affirmed on T+1 to NSCL. Based on it, NSCL nets the position of counterparties to determine their obligations. A clearing member has to pay in or pay out of funds and or securities. The obligations are netted for a member across all securities to determine his fund obligations, and he has to either pay or receive funds. Members' pay-in or payout of obligations are determined latest by T+1 and are forwarded to them on the same day so that they can settle their obligations on T+2. The securities or funds are paid in or paid out on T+2 day or to the members' clients, and the settlement is complete in 2 days from the end of the trading day. The settlement cycle for the CM segments are presented in the following areas. We can see the settlement cycle of in a cash market segment. The activity is T+2 rolling settlement. From April 1st, 2003, the trading need to be want to custodial confirmation. It may take T+1 day. Then delivery generation, it may take T+1 day. Securities funds paying, it may take T+2. Then securities funds payout T+2. Valuation debit T+2. Auction T+3. Bad delivery reporting T+4. Auction paying or payout T+5. Close out T+5. Then rectified bad delivery paying or payout, that is T+6. Re-bad delivery reporting T+8. Close out of re-bad delivery T+9. That is another area, that is risk management. A sound risk management system is integral to an efficient settlement system. The NSECL ensures that trading members' obligations are commensurate with their net worth. It has put in place a comprehensive risk management system which is constantly monitored and upgraded to preempt market failures. It monitors the track record and performance of members and their net worth. Undertakes online monitoring of members' positions and exposure in the market. Collects margins from members and automatically disables members if the limits are breached. The risk management methods set by NSE have brought the Indian stock market in line with the international market. Then the risk containment measures. The risk containment measures have been repeatedly reviewed and revised to be up to date with the market realities. Then the capital adequacy. The capital adequacy requirements stipulated by the NSE are substantially in excess of the minimum statutory requirements, as also in comparison to the stipulated by other stock exchanges. Corporates seeking membership in the ZM and F&O segment are required to have a net worth of rupees 100 lakh and keep an interest-free security deposit of 125 lakh and collateral security deposit of rupees 25 lakh with the exchange or NSECL. The deposits kept with the exchange as a part of the membership requirement may be used towards the margin requirement of the member. Additional capital may be provided by the member for taking additional exposure. The capital adequacy norms for corporates, individuals or partnership firms are presented in detailed in the eligibility criteria of trading membership. We can see another area is online monitoring. NSECL has put in place an online monitoring and surveillance system whereby exposure of the members is monitored on a real-time basis. A system of alerts has been built in so that both the member and the NSECL are alerted as per preset levels, reaching 70%, 85%, 90%, 95% and 100% as and when the members approach these limits. The system enables NSECL to further check the micro details of members' position if required and take proactive action. The online surveillance mechanism also generates alerts or reports on any price or volume movement of securities not in line with the past trends or patterns. Open positions of securities are also analyzed. For this purpose, the exchange maintains various databases to generate alerts. These alerts are scrutinized and, if necessary, taken up for follow-up action. Besides this, rumors in the print media are tracked, and where they are found to be price sensitive, companies are approached to verify the same. This is then informed to the members and the public. Then offline surveillance activity. Offline surveillance activity consists of inspections and investigations. As per regulatory requirement, trading members are to be inspected in order to verify the level of compliance with the various rules, bylaws and regulations of the exchange. The inspection verifies if investor interests are being compromised in the conduct of business by the members. Then we can see the margin requirements. NSECL imposes stringent margin requirements as a part of its risk containment measures. The categorization of stocks for imposition of margins has the structure as given below. The stocks which have traded at least 80% of the days for the previous 6 months constitute the group first and group second. Out of the scrips identified for group first and second category, the scrips having mean impact cost of less than or equal to 1% are categorized under group 1, and the scrips where the impact cost is more than first are categorized under group 2. The remaining stocks are classified into Group 3. The impact cost is calculated on the 15th each month of a rolling basis considering the order book snapshots of the previous 6 months. On the basis of the impact cost of so calculated, the scrips move from one group to another group from the first of the next month. For securities that have been listed for less than 6 months, the trading frequency and the impact cost is computed using the entire trading history of the securities. Then, categorization of newly listed securities. For the first month until the time of monthly review, a newly listed security is categorized in that group where the market capitalization of the newly listed security exceeds or equals the market capitalization of 80% of the securities in that particular group. Subsequently, after 1 month, whenever the next monthly review is carried out, the actual trading frequency and impact cost of the security is computed. To determine the liquidity categorization of the security, daily margin comprises of VAR margin, extreme loss margin and mark-to-market margin. Then first is value at risk margin or VAR margin. All securities are classified into 3 groups for the purpose of VAR margin. For the securities listed in group first, script-wise daily volatility calculated using the exponentially weighted moving average methodology is applied to daily returns in the same manner as in the derivatives market. The script-wise daily VAR would be 3.5 times the volatility, so calculated subject to a minimum of 7.5%. For the securities listed in group second, the VAR margin is higher of script VAR 3.5 sigma or 3 times the index VAR and it is scaled up by root 3. For the securities listed in group 3, the VAR margin is equal to 5 times the index VAR and scaled up by root 3. The index VAR for the purpose would be the higher of the daily index VAR based on the NSE Nifty 50 or BSE Sensex. The index VAR would be subject to a minimum of 5%. Then security specific margin. NSECL may stipulate security specific margins for the securities from time to time. The VAR margin rate computed as mentioned above will be charged on the net outstanding position, the buy value or sell value of the respective clients on the respective securities across all open settlements. There would be no netting of positions across different settlements. The VAR margin shall be collected on an upfront basis by adjusting against the total liquid assets of the member at the time of trade. The VAR margin so collected shall be released on completion of pay-in of the settlement. The VAR numbers are recomputed 6 times during the day, taking into account price and volatilities at various time intervals and are provided on the website of the exchange. Then extreme loss margin. The extreme loss margin for any security is to be higher of 5% or 1.5 times the standard deviation of a daily logarithmic returns of the security price in the last 6 months. The extreme loss margin is be collected or adjusted against the total liquid assets of the member on a real-time basis. Then mark-to-market margin or M2M margin. Mark-to-market loss is calculated by marking each transaction in security to the closing price of the security at the end of trading. In the case of the security has not been traded on a particular day, the latest available closing price at the NSE is considered as the closing price. In case the net outstanding position in any security is nil, the difference between the buy and sell values is considered as notional loss for the purpose of calculating the mark-to-market margin payable. Then structure of a clearing account. A clearing account is identified in the depository system and its CMBP ID. The internal structure of the clearing account consists of 3 parts to facilitate easy bookkeeping. Arrangement of clearing account, that includes pool account, delivery account and receipt account. First thing is pool account. It has 2 roles to play in the clearing of securities. Before paying, the selling client of the clearing member transfers securities from his client account to the clearing account. After receiving payout, the clearing member transfers security his clearing account to the account of the buying client. Then another one is delivery account. The securities before pay-in, the securities move from the pool account to the delivery account. This movement will be automatic if clearing member has given such an undertaking to its clearing house or clearing corporation. It will be effected on the basis of instructions received from the clearing house or clearing corporation. If the clearing house or clearing corporation has not taken such an undertaking, a delivery instruction form must be submitted by the clearing member to its DP. At the time of paying, NSDL flushes out the securities in the delivery account and transfers the same to the clearing house or clearing corporation. Then receipt account. On payout day, the clearing house or the clearing corporation transfers securities to the pool account to the extent of net receipt through the receipt account. This account can be used to trace details of settlement-wise receipt of the clearing member. Then overview, we can see the overview of trading, clearing and settlement system at a stock exchange. On a depository perspective. Dematedly securities can be traded on at all stock exchanges connected to NSDL. Trading can be done in various windows of stock exchanges. A stock exchange may have separate windows for trading. Typically, a stock exchange has following separate windows for trading. First one is physical, that is account period. Then rolling, then auction physical, auction rolling. A separate market type is allotted in the depository for each of the above window to facilitate the settlement of obligations in each window separately. Demat securities can be delivered or sold in the physical segments of stock exchanges. However, in rolling segments, only demat securities can be bought or sold. Stock exchange may be also permit rectification of company objections or a bad delivery arising out of paper delivery in a demat form. To facilitate settlement of such rectification, the following two market types are used. First is company objection and second one is bad delivery. For each market type, the stock exchange will have various settlements. Hence, there is a need to identify each settlement within a market type separately. In order to identify each settlement, the stock exchanges normally gives a separate number for each settlement. For example, National Stock Exchange has 250 rolling settlements in a year. In order to segregate each settlement, it identifies them by a separate number. Say, the 152nd settlement number of the year 2000 is denoted as 2152. The first four characters, that is 2000, denote the year and the last three characters, 152, denote the running number for that year. Bombay Stock Exchange has 250 rolling settlements in a year. In order to segregate each settlement, it identifies them by a separate number. Say, the 152nd settlement number of the year 2000 is denoted as T500-152. The first two characters, that is T5, indicate rolling settlement on T+5 basis. The second and third character, 00, denotes the year, and the last three characters, 152, denote the running number for that year. Then off-market transfers. Any trade which is not cleared and settled by the clearing house or clearing corporation of the stock exchange is considered as an off-market trade in the depository. Consequently, the transfer is not routed through the clearing account. Such transfers take place directly between two beneficiary accounts. Both buyer and seller may open accounts either with the same DP or with different DPs. The buyer and seller will trade amongst themselves and later on will exchange money, that is, settle funds amongst themselves. The selling client would deliver securities from its beneficiary account to the beneficiary account of the buying client. This transfer is effected by the DP of the selling client on the basis of a delivery instruction provided by the selling client. Then, corporate benefits. Balances lying in the clearing accounts are not eligible for corporate benefits as these are only transit balance and not beneficiary positions. Recently, as per SEBI's press release, it was decided that the corporate actions such as dividend payment and the bonus shares in respect of balance in the clearing account which remain outstanding on the record date must be credited to the bank or clearing account of the clearing member, and the clearing member must credit the amount to his clients. This will enable the clients to receive the benefits of corporate action. The depository system to facilitate sending the names of clearing members along with the beneficial ownership is presently under development. Hence, it is necessary that as on the record date or 1 day prior to the book closure's start date of any security, there should be nil balance of that security in the clearing account as per SEBI press release. It was stipulated that for regulation of transactions between clients and brokers, the member brokers should deliver the securities purchased within 2 working days of payout unless the client has requested otherwise. As per SEBI's letter to all stock exchange, it is directed that clearing members must give instructions to their DPs for transferring the securities lying in their clearing account to the respective beneficiary accounts immediately after payout. All clearing members must also ensure that the balance in the clearing accounts are brought to nil within 15 days of payout. Then SEBI risk management system. The primary focus of risk management by SEBI has been to address the market risks, operational risks and systematic risks. To this effect, SEBI has been continuously reviewing its policies and drafting risk management policies to mitigate these risks, thereby enhancing the level of investor protection and catalyzing market development. The key risk management measures initiated by SEBI includes categorization of securities into Group 1, 2 and 3 for imposition of margins based on their liquidity and volatility, then VAR based margining system, specification of mark-to-market margins, specification of intraday trading limits and gross exposure limits, real-time monitoring of the intraday trading limits and the gross exposure limit by the stock exchanges, specification of time limits of payment of margin, collection of margins on upfront basis, then index-based market-wide circuit breakers, automatic deactivation of trading terminals in case of breach of exposure limits, then VAR-based margining system has been put in place based on the categorization of stocks based on the liquidity of stocks depending on its impact cost and volatility. It addresses 99% of the risk in the market. Additional margins have also been specified to address the balance 1% cases. Then collection of margins from institutional clients on T+1 basis. The liquid assets deposited by the broker with the exchange should be sufficient to cover upfront VAR margin, extreme loss margin, MTM and the prescribed BMC. The market-to-market margin would be payable before the start of the next day's trading. The margin would be calculated based on gross open position of the member. The gross open position for this purpose would mean the gross all net positions across all the clients of a member, including his proprietary position. The exchanges would monitor the position of the brokers online real-time basis, and there would be automatic deactivation of terminal on any shortfall of margin. Now we can see what happens when you buy a stock. Day first, in the day first, the trade day, that is maybe for example it's Monday. Assume on 23rd September 2019 Monday, you buy 100 shares of Reliance Industries at rupees 1000 per share. The total buy value is rupees 1 lakh. The day you make the transaction is referred to as the trade date, represented as T day. By the end of trade day, your broker will debit rupees 1 lakh and the applicable charges towards your purchase. So an amount of rupees 1 lakh plus rupees 103, which includes all the applicable charges, totaling 1,103 rupees will be debited from your trading account and the day you make the transaction. Do remember, the money goes out of your account but the stock has not come into your demat account yet. In the day second, trade day plus 1, that's maybe Tuesday. The day after you made the transaction is called T+1 day. On T+1 day, you can sell the stock that you purchased on the previous day. If you do so, you are basically doing a quick trade called buy today, sell tomorrow, that is BTST trade, or acquire today, sell tomorrow, ATST trade. Remember, the stock is not in your demand account yet. Hence, there is a risk involved and you could be in trouble for selling a stock that you don't really own. This doesn't mean every time you do a BTST trade, you end up in trouble, but it does once in a way, especially when you trade B group and illiquid stocks. Then day 3, that is trade day plus 2, that is Wednesday. On day 3 or T+2 day, around 11 AM, shares are debited from the person who sold you the shares and credited to the brokerage with whom you are trading, whom will in turn credit it to your demat account by end of the day. Similarly, money which was debited from you is credited to the person who sold the shares. The shares will now start reflecting in the demat account, indicating that you own 100 shares of Reliance. So for all practical purposes, if you buy a share on day T day, you can expect to receive the shares in your demat account only by end of T+2 day. The shares are available for transaction on T+3 day. Then what happens when you sell a stock? The day you sell the stock is again called the trade day, represented as T day. The moment you sell the stock from your demat account, the stock gets blocked before the T+2 day. The blocked shares are given to the exchange. On T+2 day, you would receive the funds from the sale, which will be credited to your trading account after deduction of all applicable charges. To conclude this module, in the current module, concentrated mainly on clearing and settlement of securities, entities connected with the dealing of securities, clearing and settlement process, settlement cycle, risk management, and the margin requirements, and all those things. Okay, thank you.